Hi, this is Vernon Hills Advanced Accounting class, and we are a little obsessed with the Powerball winnings from last week. So we decided to go ahead and make a video to the Powerball winners with our breakdown and recommendations as to whether they should take the lump sum of $381 million right off the bat, or if they should go with the 30 annual payments of $18.8 million. So I'm going to turn it over to my class and let them give you their take and their calculations of how they feel you should make your decisions.
Alright, in order for this comparison to work, we're going to have to assume a couple things. So first off, we're assuming that we're either investing all of our money or an equal percentage of the money. So we're going to assume that we're investing all of the money. Second off, we have to assume the same time and frequency of compounding. So we're going to assume that it's going to be 29 years and 30 annual compounds. And then lastly, we're assuming that there's going to be the same interest rate between both accounts. So in order to find the best interest rate for the calculations, we looked at the New York University Stern School of Business study, and they took information from the S&P 500 returns. According to the study, the last 86 years brought back a 9.6% return. For the last 49 years, there was a 9.84% return, and the last 9 years, there was a 7.6% return. So in order to keep our calculations safe, we're going to assume that there's going to be a 7% rate of return.
Okay, so using the 7% interest rate, we use TVM calculations to solve for future value, and we assumed it was $381 million for the lump sum and $18.8 million for the annuity. Even though that's pre-tax and we're going to assume it's one person, the ratios will be the same. So solving for the future value of the lump sum with 7%, we got $2.9 billion for the future value, and then solving for the annuities with the 7% rate, we got $1.9 billion for the future value. Okay, and then to test the other extreme, if the economy is to crash, we use the 1% interest rate. So for the lump sum of $381 million, we solved for future value and got $513.5 million. And then for the annuities of $18.8 million with the 1% interest rate, we solved for future value and got $660.5 million.
When we evaluated the two extremes, as you can see, the 7% for the lump sum was better, and then the 1% for the annuity was better. So we had to find an in-between rate where our investments equaled out. So we guessed and checked around 3%, and then we lowered it down to 2.968% where our lump sum and our annuity equaled out to $916 million. So if you think you can get a percentage of 2.968% or better, you should go with the lump sum. If you don't think that, you should go with the annuity. And based on the New York University research, we definitely think you can get a percentage 2.968 or better. So we would go with the lump sum.